For decades, Bernie Madoff ran one of the most trusted investment firms on Wall Street. Big banks trusted him, charities trusted him, retirees trusted him, and not one of them knew that he never made a single real trade on their behalf. Not one. $64 billion. Gone. Not stolen in a heist. Not taken at gunpoint. Taken with a spreadsheet and a promise. By the end of this video, you will know exactly how the math worked, why it was always going to collapse, and the one red flag that every single one of his investors missed. We're going to break this into 3 parts: the promise, the machine, and the collapse. Understand all 3, and you will never look at an investment pitch the same way again. The promise, the 2 slices problem. Here is where it starts. Bernie told his investors he could deliver steady, consistent returns around 10 to 12% every single year. Good years, bad years, did not matter. The number just kept going up. Think about what that actually means. The real market goes up and down. Some years you gain 20%. Some years you lose 30%. That is just how it works. Because real businesses have good quarters and bad quarters. Real prices move, real economies shift. So imagine Bernie is throwing a pizza party every Friday, and he tells you, no matter what happens, you are getting exactly 2 slices of pepperoni. Rain or shine. Pizza prices up, pizza prices down, shop closed, shop open, 2 slices every single week guaranteed. That sounds great. But think about it for a second. No real pizza shop can promise you that. Costs change, supply changes. Some Fridays there just is not enough pizza. The only way Bernie can guarantee 2 slices every single Friday is if he is not actually buying the pizza the normal way. Something else is going on in that kitchen. That is exactly the problem with what Madoff was selling. Real markets do not move in a straight line. Nobody gets 10% a year every year like clockwork. The math just does not work that way. So when someone shows you a track record that's smooth, that consistent, that is not skill. That is a script. And here's the thing that makes this so hard to catch. The returns were not outrageous. He was not promising to triple your money overnight. He was promising something boring, something steady. And that is exactly why people stopped asking questions. It felt safe. It felt almost too reasonable to doubt. The psychology is simple. When something looks boring and reliable, we stop looking closely. We assume boring means honest. But in investing, zero volatility is not a sign of a great strategy. It is a sign that something is being hidden from you. If the pizza never runs out, it is worth asking, where exactly is it coming from? So that is the promise. Now let us look at the machine he built to keep it going. The machine, how the bucket stays full. So Bernie is throwing this pizza party every Friday. 2 slices guaranteed. But he is not actually buying pizza. So where is it coming from? Here is what he was actually doing. When a new guest shows up and hands over their $10, Bernie takes that money and uses it to buy pizza for the guests who came last week. Then next week, when even more new guests show up, their money pays for this week's guests. And so on. Every single week. That is a Ponzi scheme. Old investors get paid with new investor money. There are no real returns. There is no kitchen. There is just a very busy front door. Think of it like a bucket with a hole in the bottom. Money flows in from the top. New investors joining. Money leaks out from the bottom. Existing investors collecting their so-called returns. As long as you keep pouring water in faster than it leaks out, the bucket looks full. It looks healthy. Nobody panics. But here's the brutal math. The bucket never actually fills up. It just delays going empty. Every dollar Bernie paid out as a return was a dollar that had to be replaced by a new investor. And because he was promising 10 to 12% a year, the amount he owed kept growing. The hole in the bucket was getting bigger over time, not smaller. To keep this going, Madoff needed a constant stream of new money coming in. So he did something smart. He made the whole thing feel exclusive. You could not just walk up and hand Bernie your money. You had to be invited. A friend had to vouch for you. People talked about it like they had gotten access to something rare. And that is a very clever trick. Because when something feels exclusive, people stop asking hard questions. They start worrying about getting left out instead of asking whether the opportunity is real. The exclusivity was not a feature of the investment. It was fuel for the machine. On top of that, Bernie sent out account statements every month, trade confirmations, portfolio breakdowns, official-looking paperwork showing exactly where your money was and how it had grown. All of it fake. Every single document was fabricated. There was no trading account, there were no positions, just paper designed to look like proof. And because everything looked so clean and professional, nobody pushed back. The paper trail existed specifically so you would not go looking for the actual trail. Here is what that means for you. Complexity and exclusivity are not signs of quality. Sometimes they are just a curtain. If someone hands you a thick stack of documents, that does not mean the documents are telling the truth. If someone says you are lucky to be in this, that is not a compliment. That is a pressure tactic. The machine Madoff built ran on trust and paperwork, and both of those things can be faked. The bucket had a hole in it from day one. It was never a question of if it would empty. Only when. The machine ran for decades. But the math was always going to win. The collapse when the faucet turns off. In 2008, the financial crisis hit. Markets crashed. People panicked, and when people panic, they want their money back. All at once, Madoff's investors started asking for redemptions. They needed cash, they wanted out, and the request totaled around $7 billion. Bernie did not have $7 billion. He never had anything close to that sitting in an actual account. The bucket was already nearly empty before the requests even started coming in. When the faucet of new investors slowed to a drip, there was nothing left to keep the water level up. This is the part that people get wrong about how it ended. Most people assume someone on the outside cracked the case. A sharp investigator, a suspicious regulator, a whistleblower who caught him red-handed. But that is not really how it happened. The scheme did not get exposed from the outside. It collapsed from the inside. The math simply ran out of runway. Madoff told his sons what had been going on. They reported him to the authorities. And in December 2008, federal agents showed up at his door. Now the victims. This is important because it is easy to picture the Madoff story as a story about rich people losing money they could afford to lose. But that is not the full picture. Yes, there were wealthy clients and big institutions, but there were also charities that lost their entire endowments, retirees who lost their life savings, people who had done everything right, saved for decades, trusted a respected firm, and ended up with nothing. That is the real cost of the math, not a number on a screen, people's actual lives. And here is the lesson the math teaches. A Ponzi scheme is not a crime of genius. It is a crime of delay. Every single one ends the same way. The faucet slows, the bucket empties, and the people who got in last lose everything. The only variable is how long it takes. Madoff's version lasted longer than most. But the ending was always written into the math from the very first pizza party. So now you have seen the promise, the machine, and the collapse. Let us put it all together. Here's the thing. The promise, the machine, and the collapse are not three separate stories. They are one system. The promise built the trust. The machine used that trust as fuel. And the collapse was baked into the math from the very first day. Madoff did not beat the market. He just delayed the math long enough that people stopped asking if he was. So here are 3 red flags to keep with you. First, consistent returns that never dip. Real investments have bad months. Second, exclusivity as a selling point. You are lucky to be in this as pressure, not proof. Third, paperwork you cannot independently verify. Documents are easy to fake. If this helped you see how the math actually works, subscribe. We break down one money concept at a time. Start small, stay consistent, and I will see you in the next one.